So imagine inheriting a $4 million home and being told you owe hundreds of thousands in capital gain taxes. That's a nightmare most people fear. But here's the twist. Thanks to a loophole in the tax code, your heirs might owe nothing.
That loophole is called the step-up in basis. When you pass away, your heirs inherit assets at their current market value, not what you originally paid. Decades of gains, poof, gone for tax purposes.
Let's jump into it.
Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here with certified financial planner and Trevor Bell. Trevor, what's cracking, baby?
Rob, what's going on, my friend?
Is this your first time? I feel like it's not, but it is.
It's first formal one, I'd say. We did a Medicare one a couple months back. But first one solo with just the man Rob here.
It's nice to say certified financial planner.
Yes.
That's a big W.
Yes,
Trevor
I'm very happy.
Has just passed the certified financial planner. He's only 23 years old. The CFP board only gives a list of people under 30. He's 23. So let's put that in perspective. To get your CFP at 23 years old, you must have had to have 2 years of experience before leaving college. Right. And then you have to do all the education, the test, and you have to basically pass everything the first time.
Right. Well, not necessarily have to pass the first time. Thankfully, I did. Yes. So that made it easier and got it done quicker.
23 years old, bro. You had to you kind of did have to pass it the first time.
I did.
Under 23.
Yeah. To do it on that time frame, to Rob's point, you've got to have the education requirements, the experience requirements of 2 years in the industry. Thankfully have been with SFM the entire time, learning under such a great group of individuals. And they've, guided me along the way and we finally are here with that official designation. And
it's extremely impressive. I mean, you're not talking about the Series 7 you had to take, the 65, the insurance, the variable annuities.
Yep.
You passed all that and then you went and got the big boy, the CFP.
Yes.
All before 23.
That's exactly right. Why not do it early?
Why not, right? But I wouldn't be off if I'd say there might be only 5 people in the world that has done that, or actively live.
It's tough to say.
Close around that.
Yes, yeah. It's tough to say exactly, but there's no denying that there can't be that many individuals out there at 23.
You'd have to be almost studying for it in college, which you basically did.
Right.
Which is very cool. So
yeah.
let's step up
I appreciate
before
you,
we
my
get
friend.
into finance.
Thank you.
And let's jump into it for the question of the day. Today's question comes from Lee from Denver. Lee, what you got for us?
I recently inherited my family's farmland, which they purchased in the 1970s for $50,000. It's now worth $2 million. How do I sell it without paying taxes? I'm not familiar with how taxes work in this situation.
Thank you, Lee, and great question. For our new certified financial planner, Truck, please give us some insight, my friend.
So I'll actually give you a real world example of this. We recently worked with a client whose parents bought land for $40,000 back in the 70s. Now, at inheritance, it was appraised at $1.8 million. Now, without the step up in basis, taxes would have been brutal. We had an original cost of $40,000. We sold it for $1.85 million. That's a taxable gain of $1.81 million. Otherwise, at a 20% capital gains tax rate, known as $362,000 owed.
Dang, man. I mean, can you imagine, say you're a teacher or you're on a teacher's salary, right? And you inherit this property that you say your sisters want to sell.
Sure.
And then you got these capital gains and you're only making, say 60, 70 grand a year. And now you got to pay $300,000 plus in taxes.
Right.
That's a nightmare.
Right. It is.
Which would be a complete nightmare if there wasn't, a cost basis, a step up cost basis.
Right.
So comparatively, compared to $300,000 plus of taxes without the cost basis, with the cost basis or the step up cost basis, what does that look like?
Well, so with the step up in basis, they only owed tax on $50,000, roughly $10,000 in tax bill. Here's how it broke down. We had an original cost of $40,000 with a value of death at $1.8 million. Therefore, our new basis, otherwise known as the step up in basis, is $1.8 million. So the heir sold it for $1.85 million. Let's say some time went on and some appreciation happened. That's actually only a $50,000 taxable gain because of the fact that they got that step up in basis up to $1.8 million.
Now that's what I'm talking about, baby.
Yeah, absolutely.
I mean, that's a $350,000 difference, right? Savings almost.
Yes, that's exactly right.
That's crazy.
And you know better than anybody, Rob. It's not about what you make; it's about what you keep, right?
Yes, sir.
I mean, so that's the premise of everything that we've always talked about at
100%,
SFM.
brother. 100%. It's almost scary because if you don't know about this, right? Like in this situation, that simple step-up cost basis was really the difference between nearly losing a third of your inheritance or keeping it in the pocket of your families.
That's right. The step up in basis is one of the most powerful, least understood gifts in the tax code. Okay. It protects heirs, preserves family wealth, and can literally save hundreds of thousands of dollars overnight.
So that's with land, right? How does it work? Does the step-up cost basis work the same with, like stocks? So say my dad bought stock at $40,000. Let's use the same scenario, right? So he bought stock at, say, Apple, $40,000. It over 50 years, it went up to 1.8.
Sure.
The land did, right? Am I able to use that same step-up cost basis to, grandfather myself in at 1.8 if he passed that on to me?
Great question, Rob. So in layman terms, yes, you should be able to grandfather into the new basis of $1.8 million. But it could depend on type of account and so on and so forth. That's where you'd want to get with an advisor to make sure that you do, in fact, get that step up in basis.
Phew, thank goodness.
Yes. But remember, not all the capital gains are taxed at the same percentage.
Okay.
So regardless of whether they come from stocks, real estate, or other, there's several factors that actually determine the specific capital gains tax rate that applies, such as the length of time you held the asset, your income level, and even the specific type of asset that you had sold. So we always, going back to what I had said earlier, need to do a thorough analysis on each client to ensure that they are set up for success.
Thank you, Truck. Guys, this stuff is too important to guess on. Talk to a professional. If you're inheriting property, farmland, or even a stock portfolio, I'm going to leave a link in the description here if you want to talk to Trevor or any of our CFPs at Security Financial Management. And remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.